What is up, guys? My name is Nash and welcome back to another video. And today we're going to be talking about the 6 different types of stocks. So if you want to break down the entire market, you can have thousands of different types of stocks, but we want to make it simple, so that's why I have 6 different types of stocks. And I think a lot of those subcategories are going to be included in these categories that I have. The word of the video is going to be beta. So beta is pretty much a measurement of how much a stock moves up and down, right? So think of it as a measure of how much a stock moves up and down in a given time, right? So it might be in a day, a month, a year, 10 years, 5 years, it doesn't matter. So beta is going to be used to measure that. In other words, it's used to measure volatility of, the stock or the market. So the market as a whole has its own beta. So the beta for the entire market, so the entire stock market is 1. So if you have a stock that has a beta that's above 1, so that means that the stock is more volatile than the market. So it moves up and down more than the market. So those are usually considered, dangerous stocks. And it also depends on a lot of the company's fundamentals. So I would not, judge a company on its beta, but it's a good indicator of how much the stock moves, in a given time. And also, if you have a company or stock that has a beta that's below 1, that means that the company isn't as volatile as the market. So those are usually considered, safer companies because they don't really move up and down. So they're more stable. And, these are companies that have been in the game for like so long. All right, so now that we're done with explaining beta, we're going to go ahead and hop into the different types of stocks. All right, so the first one is going to be blue chip stocks. So these are going to be stocks that have been in the game or in the stock market for a long time, and they've established themselves into like big companies like Facebook, Google, Amazon. These are stocks that have a record of always making a profit, and they're just great companies. That's why you hear a lot of people say, if you have no idea what stocks to buy, just buy blue chip stocks, because those are generally safer and they have a steady cash flow and they're usually big companies. I guess another way to describe these companies is they're too big to fail. So, you can always invest in those companies. All right, so the beta for blue chip stocks is usually low. All right, so the next one is going to be dividend stocks. And the best way to describe dividend stocks is going to be, these are stocks that pay you to not sell them, right? So you get paid a dividend amount for not selling it. And there's a lot of companies that pay dividends out there or that have paid dividends before. But if you really, really want to, narrow down, the definition of dividend paying stocks, you can start looking at things like the dividend history of the company. And when you look at that, it gets divided into 2 different categories. So you have dividend aristocrats. These are going to be companies that have been paying and increasing dividends for 25 plus years. And you also have dividend kings, companies that have been paying dividends for 50 plus years. Why is it good that a company has been paying dividends for 25 plus years and always increasing them every year? So this kind of like, if you're going to invest in dividend stocks, you need to know that they're not going to cut their dividend. You have to remember that dividends can be cut anytime or reduced. So as you've seen with Corona, companies like Ford, they went ahead and cut their dividend. It was a lot of companies. So if a company is not making money, they're going to cut their dividend. So that's why you want to look into dividend aristocrats and dividend kings, because these companies, they've been paying dividends. Let's look at for example, dividend kings like Coca-Cola, paying dividends for over 50 years and always increasing them every year. So when you see a company like that and you look back 50 years ago and you see all the financial crises we've been through, and that company was still paying dividends and increasing them, so it kind of like gives you that confidence of knowing that, well, if something happens, they're not going to cut their dividends, compared to a company that just started paying dividends before Corona, and then Corona starts, and then they don't have enough money, so they cut the dividends so they don't lose a lot of money. All right, so the next type is going to be defensive stock. Defensive stocks can be blue chip stocks. They can also be dividend paying stocks. So you're going to see a lot of these categories are, kind of like a hybrid. They can be a hybrid, you can combine them. So defensive stocks are pretty much stocks that have a steady cash flow. So they always make a profit, and they're usually older companies that have passed, the growth phase. They're just kind of like on a straight line, like this, because, they have a steady cash flow. So they don't usually have a lot of jumps, or a lot of drops. So the beta for defensive stocks is usually low, and also for dividend stocks, the beta is going to be low for those. Yeah, so there you go with defensive stocks. And for the next type, which is actually the opposite of defensive stocks, this is going to be cyclical stocks. So this is pretty much companies that are affected by the market conditions. Let's say the economy is doing good, everyone is getting paid, everyone has money to spend. You go to the movies because you have extra money, right? You don't need to go to the movies, but you go there because it's fun. Now imagine if the economy was going down and people don't have a lot of money to spend, you're going to see people try to cut back on things that are not needs, right? So you're going to cut back on wants. So you're going to cut back on going to the movies, but you're not going to cut back on buying food because you need food to survive. So all those companies that are classified as needs, things that you need to buy, those are going to be the defensive companies, because even if the economy is going down, you're still going to buy those things, right? Because you need them for survival. But on the other side, cyclical companies, so these are going to be things you don't need, but you just want them for either fun or whatever reason that you want them. So the beta for cyclical stocks is usually pretty high. It doesn't really go with the market, since the market does not measure the economy, but the economy affects cyclical stocks because people only spend money when they have money to spend. So it's kind of like a weird situation right there, but those are cyclical stocks. So a good example for cyclical stocks could be maybe the airlines. People tend to travel more on holidays, which is a cycle. People don't travel a lot all the time because they're working, but when you have free time, which is usually holidays, they'll travel a lot. So that creates a cycle, which makes it a cyclical stock. All right, so the next one is going to be a growth stock. So this is, a good example would be Tesla. It's a growth stock. So these are going to be stocks that have, high earnings. They always jump up by a lot. And, they also have the potential to go down by a lot. So you can look at Tesla and you can see the growth that it has. That's definitely a growth stock. You can look at Shopify. You can look at Google. So growth stocks usually don't pay dividends because they are reinvesting their profits back into the business, compared to, dividend paying stocks. They usually are, past the growth phase. So the extra money they have, they pay that money out to investors as dividends. So growth companies, they're still growing. They need the money to reinvest back into the business so they can grow even bigger. So the beta for these stocks is going to be pretty high, since these stocks are, in the growth phase. And the last one is going to be penny stocks. So everybody knows penny stocks. So these are going to be stocks that are under $5, which sounds like a really good deal, but at the end of the day, the beta is really, really high, and they're usually super dangerous. A lot of people lose money trading penny stocks, but hey, sometimes you might find one of those lucky ones that go from $1 to $20. Yeah, so there you go. So those were the 6 different types of stocks, and of course, some of these can be hybrids. You can mix some of these, so you can have something like a dividend stock that's a defensive stock that's also a blue chip stock. So some of these can definitely be merged into one and create different hybrids. But that is pretty much it for this video. Let me know if I missed anything, if you think something else needs to be added. Thank you so much for watching. I'll see you guys on the next one. Peace.